The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. This is Bobby Rains here for our once every 3 weeks members-only workshop. Welcome to the welcome everybody. Let's get started. So this is our pretty much our standard agenda. We'll do a little bit of a market update, talk about what's going on in Investors Observer, and then the rest is driven by you, the listener/subscriber. Questions, site demonstrations, anything else you have that you'd like my opinion about. As always, a reminder, it's too late now, but we can prepare slides for questions that are submitted ahead of time. Just mention workshop when you mention workshop ahead of time when you send it in, and then we'll usually try to get you an answer to your question back, so you're not waiting until the workshop. And then from there, I can put slides together and do a little bit of a presentation in the next workshop. All right, so with that, let's get into the market update. 2 years of S&P 500. You can see we passed the early 2018 high. We're working on the late 2018 high. So we're kind of between here. You can read the market update from last Friday, or the weekend review post from last Friday. We have a few more support and resistance lines typically there. That piece will actually be coming out on Thursday this week because there is no Friday. So that's, you can keep an eye on things like this there as well. I don't really have a lot to say about this other than that, it's also currently earnings season. That certainly could provide the fuel to help us push out to new all-time highs. That relies on the reaction to earnings being good. And we'll talk about that more in a little while. This I thought was interesting. The NASDAQ is, again, not quite back at old highs. But the NASDAQ 100 is sort of starting to break away from the NASDAQ as a whole. And the NASDAQ 100 is just the largest 100 companies in the list on the NASDAQ by market cap. The QQQ ETF, for example, tracks the NASDAQ 100 as opposed to the full NASDAQ composite. As you can see, there's some, we're starting to get some outperformance from the large caps, while the rest of the index kind of lags, which is a little bit interesting. It's partially interesting because that outperformance showed up here and here before some drops. It didn't show up here before that drop, so it doesn't necessarily mean it's predictive, but it is sort of an interesting thing to keep an eye on. And then the big story, certainly the last week or two, although this has definitely gone on for longer. This is SPY is the white line, so that's the ETF that tracks the S&P 500, and then XLV is the blue line, and that is the ETF that tracks the S&P Healthcare Index. Healthcare has just gotten destroyed. This chart is year to date, so you can see the S&P 500 is up a little more than 16%, and healthcare is basically flat on the year at this point. This seems to all be a weird panic about Medicare for all, which I don't necessarily understand the case for. It's not getting a vote in the Senate until 2021, probably at the earliest. And even then, the leading Democratic candidates in the polls right now are unwilling to get rid of the filibuster, so it stands basically no chance of passing. So I don't know. It's certainly an interesting thing and something to keep an eye on, but I have some skepticism about the likelihood of Medicare for all coming to pass, which if this is actually a panic about that, I don't know. Seems like a whole lot of panic about something that has a relatively remote chance of happening to me. All right, so what else is going on? We still have two potential areas of concern in terms of trade. China, every day we get a little bit closer to the end is really all you can say about that. It doesn't really mean anything. The headlines have stopped moving markets. They trotted Kudlow to television yesterday to say that we're getting close to a deal, and the market yawned pretty much because we've heard it 100 times before and we have no idea what it means. In Europe, the situation is a little bit more interesting. I think it's 11 billion in tariffs on 11 billion in goods imported from Europe, but some of it's helicopters and ski suits, and some of it's cheese, and some wine and olive oil, but not a lot of things that are probably going to really hit the consumer particularly hard. And we'll see where that goes. This is a long-running dispute about aircraft subsidies. Europe pays sort of subsidies directly to Airbus, which is the big European aerospace and defense contractor, and in the U.S. we don't pay subsidies directly to Boeing, but we have, Boeing essentially gets defense contracts that Boeing gets to set the price on, and only Boeing gets to bid on. So you could look at that as sort of a subsidy, and the Europeans certainly do. So that's what that's about. There's also rumors about some talks with Japan that are going to happen. And the president still has a report about auto tariffs being a threat to national security sitting on his desk that allegedly recommends some trade protections there, but he hasn't done anything about it yet. This is another case where he could act unilaterally without Congress if he were so inclined, but we'll kind of have to wait to see how that goes. The debt ceiling is a thing that is coming. I haven't heard anything about it yet, but that deadline is in early June. I would assume we'll probably start to hear a little bit about it by the next workshop 3 weeks from now. But we'll see. I'd like to hope that everybody can be a grown-up and approve borrowing the money that they approved spending. But we'll see how that goes. The Fed normally has, there's normally something interesting going on with the Fed, but not much in terms of things that are actually going to affect the market. They're pretty much going to be aggressively patient, right? Wait to see actual inflation as opposed to wait to see things that have predicted inflation in the past is maybe a good way to think about that. And since the things that predict inflation in the past have sort of failed to be followed by inflation for a couple of years now, that I think makes a lot of sense. And there's a lot of people on TV talking about Herman Cain and Stephen Moore being nominated to the Fed, and those things are interesting, but won't really do much to markets. If they both get confirmed and start having a say in terms of monetary policy, it could be interesting, but even then, that's 2 seats out of a board that has 12 voting members at any given time. So it's not necessarily a huge thing as far as that goes. And then Brexit, we're promised not to mention again until the fall, unless something actually happens. They kicked the can for another 6 months last week, and so yay, we don't have to talk about will they or won't they for a while. Anyway, my expectation is they're not going to get it resolved in June. It'll be right up against October before they figure anything out, if they figure anything out. But we'll see. Maybe they'll surprise me there. And then not on the slide here, but earnings is, kicked off last week. We've had a bunch of big earnings reports this week. The individual reports seem to be a mixed bag. It doesn't look like the market is in any hurry to rally on a couple of good reports coming out in the morning, but it doesn't look like it's in any real hurry to just sell everything when, even Netflix is down today. Their numbers weren't great yesterday, but the whole market didn't sell off with any real ferocity. So that's kind of good. It seems like things are sort of being taken as they come, and we're just, good reports go up, bad ones go down, which is sort of how that should be. We're not seeing aggressive selling like we saw in the third quarter of 2018 or aggressive buying like we saw in 2017. Basically, every time anybody did anything, it was just bought aggressively for no apparent reason. So we're not seeing either of that, which is probably a healthier market. It does make it a market where picking stocks gets to be a little bit more important as opposed to just having money in the market. But yeah, that's kind of how that works. All right, so that is the end of my prepared remarks. We can go to questions now. If you have questions, just put them in the box and I'll go through them. All right, so we have a couple of questions here. Let's get to Sonia first. She has a question about how loop trades work, and then she describes it as a double call option where you buy 2 calls with different strike prices. It's not, I've seen people do that, Sonia. I would call of that a ladder more than a loop, but I suppose you could call it a loop, and I don't know what the expiration dates I don't know what the expiration dates on those 2 calls are necessarily, but assuming it's the same price or the same expiration date and just different strike prices, you essentially end up paying a little bit more for a call that's more likely to make money and another one that's a little more speculative. The one that's further out of the money is typically going to be more speculative. You're not going to pay as much for it, but it has a higher chance of a bigger percentage return. And then the one that's closer to the money, you have a higher chance of sort of making something on, right? Like further in the money or closer to the money. As you go, think about going down in price, you're going to have a higher, higher cost to buy the call. It'll also tend to lose time value a little bit less, but it also the gearing is less. I think the Greek for that is gamma, which means that for every dollar the stock goes up, your option will go up more if it's way out of the money. So if you look at the option chain and you see options that are pretty far out of the money and they cost like a nickel, if the stock makes a big move, you can make a huge return on an option that you bought for a nickel. But also it'll probably be totally worth it, and you'll just have to eat that nickel a week before expiration sometimes because there's just no time value left. Whereas if you buy something closer to the money, if you decide to close it early, you won't necessarily have to take the full loss, but your returns on a percentage basis won't necessarily be as large. Okay, so that's that. All right, and then Rick says, Rick essentially is making the same joke that we've been making here for a couple weeks about whether or not Brexit or a China deal will happen first. My money would have been on Brexit 2 weeks ago just because it seemed like they might run into that hard deadline, but now it's anybody's guess as far as I can tell. And we have a couple of questions here about portfolio trades. So the first is the Mohawk vertical spread. Let me pull up my website here. All right, we got this guy that's expiring tomorrow. It is right now. I liked the action in Mohawk today in terms of opening higher and then falling. Little rally into the close isn't great, but it's not going to be a killer. Unless it absolutely falls off the cliff at the open tomorrow, we'll probably close it during the day as opposed to risking letting it end up between the 2 strike prices there, which isn't necessarily the end of the world, but creates a mess you have to clean up on Monday because you get the stock put to you and then you have to sell it. And I don't really feel like holding the stock over a 3-day weekend. That's not necessarily great either. So we'll probably close it tomorrow, like I said, unless it just falls off a cliff. If it makes a hard move below the 130 sold call there, then we'll hang on to it. But right now we could close it for a small profit probably, somewhere around break even or a small profit, and I expect that'll probably be about the same tomorrow. And then we have another question about MCK, which is much less optimistic. Yeah, at this point, we're going to close it when we see some strength. I didn't really want to sell into a 4% down day today, just because I think I can get a better price than that on the way out. But yeah, I don't know. You've heard my opinion about why healthcare stocks are down and why it seems like that's a weird reason to sell healthcare stocks. It turns out that doesn't make the stocks go up. That I think the price is wrong. But yeah, if this was a covered call, we might consider holding on to it for longer. But given that it was a diagonal spread and we have a call that expires on the 17th of May, we're getting to the point where it's not going to come back to enough to really warrant holding on to it. So we're looking for the exit. So we could close that, I would say, as soon as tomorrow. But yeah, probably the first, the next update we'll probably dump it. It put together a nice rally the first 2 days of this week, and I was hoping to see that continue. But yeah, after today, I'm ready to get out. I don't see it coming back. I think the downside is worse than the upside at this point. Or the downside is bigger than the upside at this point. So I'm ready to bail. All right, do we have other questions? Oh, you know what I forgot was, yeah, we do have some exciting stuff coming soon in terms of what's going on in Investors Observer. It's not soon enough that I have a date for you, but we are going to be rolling out some new stuff later this year. Maybe late spring, maybe early summer, we'll see. But that'll be pretty exciting. I think everybody's going to like that. And we'll hold maybe if the launch falls near our regularly scheduled workshop, we'll roll it out then. If not, we'll probably put together a special presentation that everybody can come to at that point. Oh, another update. We didn't get filled at the open this morning, but the Yeti trade we put out in the covered call portfolio did get filled sometime around the middle of the day today, right at $29.90. So that was our price. So we're going to consider that trade open now, and we'll go from there with that. Yeah. All right. Well, we're not getting too many questions today. I've answered all that are in there, so I guess we can go ahead and sign off if no one has any more questions. We'll be back again in 3 weeks, which is roughly, or even exactly, May the 8th. So look for invitations a couple days ahead of then. We'll be putting the recording and link to download the slides that we used today on the website sometime tomorrow probably, and we'll send you an email about it as well. All right, well, thank you all for coming, and we will talk to you next time.